Good evening and welcome to episode 52 of SCOTONOMICS. It's nice to see everyone joining us on Facebook, YouTube and also on Twitter. So please do say hello in the chat. Now tonight I think is one of the most important episodes that we've ever had on SCOTONOMICS. And that's not just because of the topic that we're covering, which is pensions, but also in the way that we're going to discuss it. Now, pensions is one of those areas similar to currency that we know that people think about when they're considering independence, and that's why we wanted to cover it tonight. But there was two ways of approaching the issues of pensions. And the first way is to kind of look at pensions and justify that it would exist, that a good state pension would exist in an independent Scotland. Now, we believe that's for others to try and find the evidence to suggest that that wouldn't be the case, that somehow Scotland is uniquely incapable of providing a state pension, a decent state pension for its inhabitants. The other way is to talk about what we can do with a new approach to a pension in Scotland. And that's what we've decided to do tonight. Now, I think this is really going to be a theme and an approach for us as we get into more episodes of SCOTONOMICS to really look at what we can do rather than try to justify that. And I think the independence movement has been hamstrung trying to justify these things which exist in every other small, successful, independent nation. So I hope you really enjoy this interview with Jim Osborne, and I'd love to see your comments and your questions in the chat. It is a really fascinating way of thinking differently about how a state pension would be run in Scotland. Enjoy.
Hi, Jim. Welcome to SCOTONOMICS. Jim Osborne, do you want to tell us? Hiya. Do you want to tell us a little bit about yourself and give the audience some background into why we've brought you onto the show today?
I worked for 28 years in the general insurance industry in the claims section. During that time, I was a senior trade union rep for nearly 4,000 staff for 20 to 25 years. And towards the end of my time with the company, I was a pension trustee for 7 years, and I achieved early retirement in 2007. I did intend to return as a pension trustee once I'd retired, but several years later, by which time we were in the run-up to the independence referendum. And I began to think about the importance of pension funds within the context of independence or a pro-independence economy. So I've been kind of thinking about that and writing about that for quite a number of years now.
Yeah, because we've seen your articles in the National. Yeah. And Jim, also you have a background in economics. You're an economics graduate, and when you left university, you did economics, didn't you?
Yeah, well, it's called a BA Economics, but I didn't just study economics. I studied economic history, politics, sociology, all sorts of stuff. So it wasn't just economics.
Great.
At the moment, a lot of people are worried that when Scotland becomes independent, we won't be able to pay pensions. Could you explain if that's a likely scenario or not, and how would pensions be paid in an independent Scotland?
Well, I think the state pension one's relatively easy. We have to rely on the figures from GERS, but I think the GERS figures for last year demonstrated that the cost of state pension in Scotland was 8.5 billion, and that national insurance contributions attributable to Scotland came to 11.5 billion. So from that point of view, that we've got it covered, because that won't change. I mean, Scotland collects its own national insurance contributions and pays its own state pension. That will be unaffected. The question is, how does Scotland increase the state pension? And that is a question that we still haven't really resolved, because we don't have a clear position on the currency. If we have our own currency, we can increase the state pension to whatever level our productive capacity can accommodate. There's no point in having a massive state pension without the ability to supply the needs of pensioners without importing. I mean, if we have a massive pension, that massive state pension, we can't supply pensioners' needs domestically, then we're going to increase our imports. So there has to be a balance struck there. But we can't really think about seriously increasing that state pension, unless we've got monetary sovereignty. And that's why the likes of the Scottish government, the SNP leadership, even believe in Scotland, I've got to think about committing to the currency question, because all these promises about increasing the state pension are meaningless without the currency.
You'll see that we've had a lot of consternation politically in the past wee while, and I think a lot of people are starting to think that somehow the markets control the UK and not our politicians. So we know that pension funds are part of that market landscape. Do you want to talk about how important they are in as part of the markets?
Pension funds, to me, they're essentially a conduit between individual savers who are saving for a pension in the future, whether it's through a defined benefit pension or a defined contribution style of pension. We can maybe talk about the difference between those two afterwards, if you like. They're a conduit, and they funnel huge amounts of money into the financial services industry. The financial service industry has got a vested interest in maximising the amount of money that flows into their coffers for them to speculate with, basically. So the problem we have is that the financial services industry controls the narrative, and that narrative is really something that we need to dig through. We need to dig through the noise and get to the fundamental issues behind pensions, which is really what I want to try and get to today during this discussion. There's a lot of noise, there's a lot of techno babble. It's completely beyond people. People don't understand the financial jargon, neither do I. Complex financial engineering, and it's all part of a process of keeping afloat a system which is basically broke. What we've seen recently, the impact of the increasing gilt yields as a result of the fall in the price of those gilts. Now that affected defined benefit pensions. It didn't affect defined contribution pensions, and the reason for that is that defined benefit pensions are basically a promise by an employer who set up the scheme and the fund to pay a pension sometime in the future when each individual retires, which is based on the length of their service and their earnings at retirement. So it's a promise to pay something. A defined contributions pension doesn't contain any promise whatsoever. The person just saves as much money up as they can. Somebody invests it for them to try and get the maximum return. And then when you retire, you look at what you've got in your pot and you make the best of it to see you through your retirement. So the two types of pensions are completely different. And the recent crisis, which has been in the media recently, affected defined benefit pensions. And it's had a big impact on them because most of them are now closed. We are entering the final phase in the life cycle of DB pensions as they are currently designed. They've gone through a life cycle for the last 50 years. And this is the bit that I had the graphic to try and talk through. So I'll just talk through what the basic problem I think is with DB pensions. So at the start, when a DB pension is set up, there are no pensioners. There are only contributors. So monies flow into that fund, they get invested, and so on. And for it'll be a number of years down the line before the first pensioner claims a pension. We've got this thing called the dependency ratio, which is the ratio of the number of active contributing members to the number of pensioners. So at the start, it's infinity because there are no pensioners. Okay, so you can see at the start. I mean, this is a generic chart, but essentially every defined benefit pension scheme, every employer-sponsored defined benefit pension scheme will follow this life cycle trajectory in one way or another. So at the start, there are no pensioners. So that the contributions are all going in to build up the fund is invested and so on. And then at some point down the line, the first pensioners start to retire and claim pensions. There are increasing numbers of pensioners to workers. Now, what happened in my own company scheme, and I remember this from when I was a trade union negotiator in the mid-90s, was the first stage in this life cycle of the pension fund, where contributions are no longer the primary source of liquidity to pay pension benefits. And so they're beginning to increasingly rely on investment returns to supplement that contribution income. So the first stage is that an employer then comes along, having consulted their various experts and advisors, and they say, come on, chaps, we need to talk to you about changing the rules of the scheme. We need to have a tweak the benefits, and we need to increase the contributions. I can remember negotiating those first changes to our pension scheme in the mid-90s. That's pretty common right across the whole DB pension world. And any trade union organisation in any company that has a DB pension scheme will have gone through this process already. The next phase came in my scheme 10 years later, when they announced that they intended to close the scheme to new members. So any new member would be allocated, any new employee would be allocated into a defined contribution pension scheme. The existing members were kept in the DB scheme. Now, the trade union can't push up against that. They can't push back against that because the existing employees are not affected by it. They are still getting their DB pension. So the next phase is several years down the line, when the workforce is now contains a high proportion of staff who are in a DC scheme and a lower proportion of staff who are in a DB scheme. And then they pull the rug under it and close it all together, and nobody can do anything about it because half the workforce hasn't anything to lose. So that's the next phase. They close it altogether, and everybody is then transferred into a DC scheme. So once the scheme is closed, there are no contributions coming into it whatsoever. So it's entirely dependent upon investment returns. And so you see a kind of a period where different models, different pension funds will adopt different financial engineering models, depending on their advisors and fashions of the time and stuff like that. I mean, I can remember back in the early 2000s when the whole industry was taken aghast by Boots pension fund, which completely cashed in all its equities and just invested everything in bonds. That was the first big move into what's called liability-driven investment, and everybody was aghast at that. But obviously, it started a fashion. You get into this phase where all kinds of financial engineering is used, and what they're trying to do is they're trying to balance two different things. One is they're trying to maintain the liquidity they need to pay current pension benefits, but also they're trying to grow the fund so that it can meet its future liabilities. None of this is actually made any easier by the volatility in the way liabilities are measured. A DB pension scheme has to go under an actuarial valuation every 3 years. And the actuaries who do these valuations, they make all kinds of assumptions about the future. They make assumptions about future inflation. They make assumptions about future wage growth. And the final result is also affected by the discount rate, which is linked to interest rates. Now, interest rates go up and down. So what we've seen recently, I mean, for example, in the university superannuation scheme recently, last year, well, they're heading for an industrial dispute anyway, but last year there was severe risk of an industrial dispute, primarily over the pension scheme, because the universities were proposing to increase the contribution rate, combined contribution, employee contribution rate, to 56%. I mean, that is just unsustainable. And that's because it was declared that the fund was in deficit. Now, part of the reason it was in deficit was because a year ago, interest rates were really low. Now, interest rates where they are, that same fund is in surplus. So how the hell is an employer supposed to manage the fluctuations in the assessment of these liabilities? It's a huge burden for employers. Because even in a closed scheme, if it's in deficit, an employer has to start putting his hand in his pockets to supplement the fund.
I was just going to take it back to the basics for some of our audience as well. So, you know, your pension funds are, my understanding is that when you invest in a pension, round about 30, somewhere between 30-40% of it is going into government bonds, which is you saving with the Bank of England, essentially. And then the rest of it is going into various other investments with different levels of risk. So You hand your money over to people to invest that money. Hopefully they know what they're doing, and you get something back at the end of it. There should be something coming back anyway, because obviously the government pays interest. It can always pay interest as the currency issuer. You're definitely going to get that back. The rest of the stuff, not necessarily. Is that the case?
The investment in gilts. The first thing about gilts is that they're virtually risk-free, because a government will always pay its debts. But for a DB pension fund in particular, they're an important source of liquidity because they provide a regular stream of interest income, cash flow. So gilts are important because they match the liabilities of the fund because of their ability to provide this income stream. I don't know whether the figures are 40% or not. I'm not sure what the current figures are. I know that the local authority pension schemes have a much lower holding of bonds than some of the private sector ones. But bonds have certainly always played a very important part in pension fund investment because of that liquidity that they give them. So they're a source of regular cash flow to pay pensions. They're also low risk, and they're easy to market. They're very liquid because you can sell them quite easily on the bond markets. So they're really, from pensions point of view, they're a really low risk investment. But the problem is that they don't provide sufficient growth in asset value to meet the future liabilities, 50, 60, 70, 80 years down the line. At which point, the worker pensioner ratio is down to virtually zero. So the thing is, the funds become completely dependent on investment. Now, one of the reasons why I've advocated the creation of a national pension fund is that a national pension fund doesn't suffer from this demographic problem. If you have a national pension fund and every worker and every employer contributes into it, you can never have more pensioners than workers, unless you've got some major demographic problem, like nobody's having the kids anymore, so kids are not growing up and becoming workers, and the pensioners are just getting bigger and bigger and bigger.
I think a lot of our audience would be surprised that you say that. I think a lot of them imagine that that's what national insurance is doing. They imagine that it's ring-fenced and invested for them for their future.
Well, that is not the case. It's a form of taxation. As a form of taxation, it doesn't actually pay for the pension benefits. The pension benefits are paid directly by the state. All the national insurance contributions just cancel out some of that government deficit. And there is within the government's accounting system, there is a national what's it called? There is some kind of national fund in the accounting system, but it's only an accounting device. It's not actually a fund. It's just a way of accounting for the flow of money through the complexities of the government's accounting system. So
what would be the difference between your idea and a national insurance, which is what a lot of people imagine is what they're doing when they pay that money? What's the difference?
It would build up a fund, and that fund would be owned by the people who've contributed towards it. So it wouldn't be owned by the state. It would be owned by its members. It's their money. So it would be. It's a massive. Basically, it's a massive mutual savings fund. Basically,
okay,
that's what it would be. But that's what these pension funds are anyway.
Just to clarify the role of government debt in pension funds, could pension funds exist in the UK without this government debt? Because we often look at government debt as being a really bad thing, and we don't often look at what it actually allows us to do. Without government debt, have we got pensions?
Definitely not. We haven't got government debt. We haven't got savings anyway, of any form. Government debt is absolutely critical to pension funds and any other form of savings, to be honest with you. There was a time many years ago before deregulation of the financial services industry where pension funds were not allowed to invest in anything other than government debt. It was only with the kind of popularization of what became known as modern portfolio theory, which was developed in the 50s, but it never really took off until the 70s, where pension regulators began to allow pensions to diversify their investments on the basis that if they did diversified sufficiently and diversified their risk, then they would be considered to be prudently investing. So once modern portfolio theory became fashionable and popular and gained a hold on the industry, then pension funds began to diversify out of just holding government bonds. But before that, they were only allowed basically to hold bonds. So they are absolutely central to pensions.
Yeah, and the issue after the mini budget,
it's fairly technical, but it's got to do with this concept called liability driven investing, which is basically a way in which pension funds, and it's largely pension funds that are closed which have been using this approach to investing. What they're trying to do is balance their immediate liquidity needs to pay pensions with their longer term growth requirements. So they've used all kinds of derivatives to try and do this, mainly kind of interest rate and inflation swaps, credit swaps of various types. Now, when they enter into a credit swap with a bank, they have to put up collateral, and that's where the problem has been, because what was happening in the gilt markets was affecting these credit swaps, and the banks were then demanding more collateral. So to get the collateral, the pension funds were selling the gilts to get cash to put up this collateral. That drove the price down even further. So there was a great demand for more collateral. So that's basically what was happening. It was being driven by this demand for collateral by the banks. And I think essentially what the government did was really to bail out the banks rather than the pension funds.
People might be quite interested to find out that the pension schemes are taking part and using these financial instruments similar to what the banks were doing in, let's say, the run up to the financial crisis.
Well, what basically pensions are doing, they're investing in these collateralized. The collateralization is done by the investment banks, and so pension funds are purchasing these and acquiring these financial instruments, as a way to try and balance the competing requirements for immediate liquidity or long-term growth. So that it's another form of financial engineering. Now, when I was a pension trustee up until 2007, a lot of this stuff was niche. Most pension funds weren't doing this. We're very conventional. So, getting an understanding of how credit swaps worked and stuff wasn't something that really, as me as a trustee, needed to get my head around. But a trustee these days needs to understand this stuff. So pension funds have started to invest in increasingly complex financial instruments. Now, the massive problem with this is that none of this activity actually creates any real wealth. None of it is contributing towards the productive capacity of the economy, and that is a major problem. Richard Murphy has been going on about this for a long time, since he wrote his Making Pensions Work paper in 2010. He's absolutely right, and this is this is something that we need to address.
So would you say that really pension fund managers, to a great extent, are taking the easiest option? They're creating money in ways that are really quite easy for them, rather than actually having to sit down and think about, is this a good investment? Can this do something good in the world, etc., etc.? I know there's a lot of ethical investments starting to come up. That's definitely a thing I've seen the past 10 years.
Basically, what pension funds are doing, and their investment managers, they're trying to make money out of money. They're not trying to make money out of productive activity, and this is a problem. It's not sustainable, because what is happening is that this is creating a massive amount of financial claims on the UK economy or on the Scottish economy, without contributing towards the productive capacity of the economy to meet those claims in the future. So we're building up a huge time bomb for the future by continuing like this.
And do you think there's a problem with the Great Resignation? I'm just reading that in June in America there was 4.2 million people resigned. And, I do worry that perhaps some pension funds have actually been too good. I actually have a friend that's decided to stop working. She's just in her early 60s, and she's just going to live on less money because of the pandemic. A lot of people have made that choice. And obviously in the UK, we have the other problem where we've decided to not let young people come over from other parts of Europe to help us with our economy. And a bunch of our older people don't want to work either. So now we've got a big problem where we have lots of vacancies and no one wants to take them up.
Yeah. We're shrinking the productive capacity of the economy, and we really need to address that. Pension, sort of pension fund is only one part of that bigger picture, though.
Jim, what's your idea? How can we restructure pensions in an independent Scotland to make them work much more for the individuals and for the country as a whole?
Right. Okay. Well, I think the first thing to say is that we need to have a rethink about the wider structure of the pension system. At the moment, we've got three pillars they call it. The first pillar is the state pension, which is a flat rate pension. The second pillar is workplace pension provision, defined benefit and defined contribution schemes. And the third pillar is what they call personal pensions, where you just take out pension at your own, which is just an individual form of a DC pension. Now, to me, the problem with this doing it this way is that the state pension being a flat rate pension, there is always going to be a large number of workers who want more, and so there are always going to be a demand for a second pension. So that's the problem we need to address. So how do you do that? How do you deal with that in a way which is fair and equitable right across the whole of the population? Well, to me, the solution to that is to reverse it round, so that your first pillar in the pension scheme is the National Pension Fund, and the state then adds to that, adds to a national pension, adds it to top it up to a whatever level of pension we want to deliver is something for democratic choice. But let's suppose that as a nation we settled on we would like to see pensions at 80% of earnings at retirement. That could possibly be made up by a pension of 50% of your earnings from the National Pension Fund, and that's topped up by the state. So the state pension is no longer a flat rate; it's related to what your real retirement earnings are. So the whole thing is an earnings-related scheme. Now, we could, if we were starting from scratch, we could design a state earnings-related pension scheme if we wanted. So there wouldn't be any need for second pensions. But if we're starting from scratch, that's what we could do that. But we're not starting from scratch. What we have is a state pension combined with pension funds, which have now got a value in the UK approaching £3 trillion. Now, we can't just ignore those. We need to do something useful with them. And in terms of the independence scenario, then there's an opportunity for us to have a really good think about how do we provide pensions in the future. So we can address that. So we need to think more than just thinking about increasing the state pension. We need to think about the bigger structure of the overall system and how we integrate our existing pension funds. And of that £3 trillion, Scottish workers' assets are probably worth 200 to 250 billion on their own. So that's an enormous amount of capital that we need to think about what we do with. Now, setting up a national pension fund, to me, is the way in which we can repatriate those assets out of London. Because if we don't, then Scottish workers will be continuing to pay pension contributions into financial companies in London. They'll be exporting our pension contributions abroad. And then the question is, will the Scottish government carry on offering tax relief on those contributions? It doesn't make sense for the Scottish government to be foregoing tax income, tax revenue on pension contributions, which are going abroad and are then not being invested to help us build our own economy. So to me, this is the basic nugget behind why we need to think about setting up a Scottish National Pension Fund. There's going to be a lot of work to do it and design it and stuff, and I can't do everything myself. But we need to have this conversation about how do we do this? How do we go about doing this? And can we do this? And I believe we can do it.
It sounds like something, Jim, that you could actually probably start now.
Yes, you could. If we had the experts who are prepared to give their time and commitment to getting around and thinking about how we do this, we could start now. Just like we can start with the central bank. We can start doing it now, start thinking about it now. Make a plan, look through the issues, look at some of the complex issues that we might have to confront. I mean, the basic way to start one, simply, is you start on day one. All the new youngsters who join the workforce, they start paying into a national pension fund, and they pay into that pension fund for the next 40 years. They're not claiming on it, but once you've created that initial fund, you can then start transferring in the funds particularly from workers who are in defined contribution schemes. They can put their assets into that fund, and they can then convert them into a defined benefit pension. So you can that fund can build very, very quickly and become big. And one of the issues we'll have to address is how big do you want it to be? It could be too big. I mean, arguably, the Norwegian Sovereign Wealth Fund is too big for the economy.
Yeah, I've heard a Norwegian banker say that. Yeah,
but if Jim, this is such a good idea, why isn't it happening now?
Because I don't think people really, pensions is just under the radar. People don't think about how important the pension system is within the overall economy. The pension system is massive, and it has a massive impact on the economy and the way the economy works. There's huge amounts of capital in these pension funds, and they're being used to support financialisation and not improving our productive capacity.
I think you've got a market in the nationalist population that would jump on this, like in a flash.
Well, I'm really grateful to have this opportunity to talk here, because I want people to really start thinking about this. I mean, if you look at the Commonwealth have done such tremendous work on so many issues. But if you look through their index, it's got everything on that list apart from pensions. They're missing a big issue.
We can certainly help raise that then. So just to kind of clarify that, there's nothing at the moment stopping the Scottish Government setting up a Scottish pension fund. Is that what you're saying?
There's nothing to stop the government setting up a commission to look at it and to think about how we go about doing it.
I'm sure you could convince people that this would be a really good idea. I certainly know people that would jump at the chance to do this, within
already, even without a national pension fund, I mean, we have our local authority pension funds, which there's 11 local authority funds in Scotland. At the moment, they command about 60 billion in capital. All the money that flows, all the contributions that goes into those funds comes out of the public purse. Local taxpayers, central government grant to the local authorities, so that the local authority employers' contributions and the employees' contributions from their wages all come out of the public purse. These local authority funds are not invested in their local communities and their local economies. If you look at the Strathclyde Pension Fund's investment portfolio, there's no evidence at all that there is any significant investment in Scotland whatsoever. They've got massive holdings in a huge, diverse array of industries right around the planet. There is no clear sign that they invest much in Scotland. So our local authority pension funds, which are funded from the public purse, are investing abroad, and meanwhile, Scotland depends on foreign investment. It's just, you couldn't make it up. It's absolutely bonkers.
Jim, what I wanted to clarify now was that you've kind of painted a picture of what a pensions fund could be like serving Scottish citizens. Now, let's kind of take away independence for the moment, and let's say that that's not going to happen. Is there any movement in Westminster that's looking at pensions differently, saying, hey, there is a huge problem, let's set up a British pension scheme? Is there any kind of movement or discourse in terms of the United Kingdom for any of these outcomes?
Well, there have been some signs during Rishi Sunak's chancellorship that the Treasury were interested in finding ways to get pension fund capital to invest in the economy, but these motivations are driven by this belief that they have that the government doesn't have any money, so it has to use somebody else's. But on the positive side, they were looking at ways in which they could get, particularly they were particularly looking at how they could harness the capital of defined contribution schemes in order to get them to invest in what they call, what I called illiquid assets. So that's real assets, which you can't buy and sell very quickly. So they've been looking at trying to how they could harness pension fund capacity to help the economy, but there's no kind of bigger picture thinking right across the whole thing. It's kind of tinkering. Can we do this? Can we do that? And it's driven by this belief that they don't have any money, so they have to find it from somewhere else. So I think that initiative has had a mixed reception from the financial sector, the pension sector, because they're obviously concerned about the risk associated with investing defined contribution pensioners' money in assets which are high risk and are not easy to dispose of. So I don't think they've solved that problem, but there's certainly been some moves in that direction.
Well, our last two guests have actually been talking about the role of the financial services sector in the UK economy, but also the links to government and this idea of financial services capture. And I would imagine that if you were to have these conversations at any kind of serious level, at the UK level, one of the issues you would come across very quickly is the power of the financial services industry. And it doesn't really want all that money coming out of the products that it's selling to go into another sector, for example, manufacturing. Imagine that'd be a huge stumbling block on the UK. And I would imagine it's similar to Scotland and its connection to the financial services sector as well. And we've been saying for quite a while now on Scottonomics that Scotland needs a financial services sector, but it doesn't need a huge financial services sector. And it looks like this new approach to pensions would be another way of securing a financial services sector that does what you need for the economy.
Absolutely.
That services it rather than risking it. So it looks like there's a slightly better chance of that happening in an independent Scotland than there would be on the UK. Is there any final thoughts on what a new approach to pensions would not just allow Scotland to do economically, but how would that support Scottish citizens?
If you have a national pension fund, then its primary source of liquidity, it's its contributions, pension contributions, and they're constant because the workforce is constantly rolling over. It's always there. As people leave and retire, new people are coming in. So the contribution streams are sustainable over the long term. They don't dry up. So this is one of the things that I think we need to understand is that the most important and primary source of liquidity for a pension fund is the pension contributions income. So basically, the design of the scheme would be based, I would propose it was designed as a pay-as-you-go scheme, so that the contributions are designed to cover pension benefits every year. But you don't need to think about, well, what about 100 years down the line? You don't need to worry 100 years about the line. The state will still be here. The state is permanent. The state has longevity. Employers don't. Employers come and go. They go bust, and then the pension scheme's left with anybody to fund it. That doesn't happen that won't happen with a national pension scheme. The other thing is, just coming to your point about the financial sector, Scotland does need a financial sector. Absolutely. Finance is really critical. Money is critical, and the management of money is really, really critical. But it would be a different financial sector with different types of skills required. So we need a just transition for the financial sector if we're going to have a national pension fund. Because that national pension fund, its primary objective would be not to invest through the financial markets, but to invest directly by talking to business. So you go and become the pension fund becomes an active partner in a business. That means you need people who understand the business. So if you're investing in a wind turbine manufacturer, you need people who understand that industry, but also understand finance.
You know, for me, when I was working for myself, you'll know that I'm a counsellor now, but I just did not think I would borrow money from a bank. I'd watched the whole scenario with RBS and NatWest and the vehicle that they'd set up, which famously was shown in Spank the Banker, the film that came out about that. And you know, I imagine a lot of businesses were probably put off the idea of borrowing from a bank because although, you know, you've got to pay interest on it, there was really just a sense of, well, I just don't know if I can trust these people, you know, really at the end of the day, they just don't look trustworthy to me. And that in and of itself will have hamstrung our economy to an extent. I think what you're saying about a mutual and obviously, you know, taking on that role of being an actual investor. And we know from people that have worked in banks that they got fed up of being a retail outlet, because when I was first working, they were the people that would advise you about a business, and they seem to have completely absolved themselves of that function. And I think what you're suggesting with this mutual is that would take over that function.
And I think primarily it would be providing equity rather than you know, loans. So it would become an active equity partner. They would probably have a seat on the board of the company. They would play an active part in managing that company, and they would at the outset have an active part in setting out the ground rules like fair pay and trade union recognition and all that kind of stuff. Those are conditions that come with our investment in your company. And then when that investment is made and that company is successful, then the management and the workers in that company and the beneficiaries of the pension fund get the benefits of the profits from that company. So it's a partnership way of working, which is a win-win for everybody, and hopefully will develop our economy.
Well, that's very on message for us, Jim. Thanks very much. That's a great way for us to end the show. That's been really beneficial because, as you said, pensions are such a kind of an area that a lot of people don't really understand. We'd love to have you back on again. And what I'd like the audience to do is to give us some more specific questions for Jim. And then maybe in the new year, we can have a live episode when we're covering some of these issues, because you've got an incredible depth of knowledge and experience. And I think your idea of the Scottish National Pension Fund is really exciting, and it's certainly something I think everyone in Scotland can get behind. Jim, we're really thankful for the time you've been able to give us.
Thanks very much.
Bye-bye. Bye-bye.
Bye.